colleagues, and thank you for joining us on Tata Chemicals Limited Q4 FY19 earnings conference call. We have with us today Mr. R. Mukundan, Managing Director, and Mr. John Mulas, Chief Financial Officer. Before we begin, I would like to mention that some of the statements made in today's discussion may be forward-looking in nature and may involve risk and uncertainty. I now invite Mr. Mukundan to begin proceedings of the call.
Thank you, Suraj, and thank you everyone for joining us on the earnings call, especially since it's 6 p.m. on a Friday. We keep it as short and as crisp as possible. I have with me John, who is our CFO, and Zarir, who is our Executive Director on board. John will take us through the key financial developments for the period under review, and I will go through some of the key operating and strategic highlights. Before I begin, I just want to start by saying we had a major milestone this year. We actually crossed selling 1 billion kg packets of salt. This year it's a significant achievement, and it takes us one step closer to getting to 1.4 million ton target capacity expansion, which is announced. And the growth in this business continues to be strong. Not just this business, I'm just going to walk you through what happened in the consumer business, whose growth continues to be extremely strong, and we are seeing great market traction, not just for Tata Salt, but for Tata Sampann. Before I get into details of that, let me go sequentially into each step. Firstly, starting with the basic chemistry products, overall domestic demand remained balanced during the period. We had pockets of slight tightness in the market, which is good for us. The revenue from operations were up 25% on account of higher sales volume, better realizations. Margins remain more or less steady despite higher energy costs, and that's explained because of the tightness in the market. We could pull through the margin despite higher input costs. Moving on to international entities, TCNA operations were in line with expectations, with improved sales realization and operational efficiencies. Performance of European operations remained more or less suppressed due to higher energy costs despite improved sales realization. Kenyan operation improved substantially both sequentially and year on year. We are continuing to see a better traction in terms of higher volume and improved realization, and this trend is likely to continue. Going ahead, we continue to focus on improving operational efficiencies in the business across geographies. The good news in the business is the market is balanced to tight, and that is likely to be the scenario going forward for a certain amount of period in this business. In terms of the specialty business, the revenue from nutrition solution business for the quarter was this bit subdued, but this is a pilot plant with a pilot revenue with a high. But we are spending marketing spends in this business to bring on stream to be ready for the market with a new on stream. Nutraceuticals along with silica are still in nascent stage but are shaping up well, and we are setting up a dedicated state-of-the-art facility. We are confident that in the coming years, post-stabilization, the same will contribute positively to overall growth of the business. A quick update, the Nellore plant for nutrition solution business is in the final stages of commissioning. We would be commissioning it pretty close to end of this month. The plant will then go through pilot production before it starts to get into commercial production. Our targeted date for commercial launch, commercial production is somewhere around the end of December, by which time we hope to get both FDA and GRAS and various other approvals needed for export shipments coming out of this plant. In terms of Cuddalore, which is our allied silica plant, we're making highly dispersible silica for both food grade as well as rubber grade and tire grade businesses. The trial runs have been very successful, and we expect to start commercial production very soon. On the agrochemical business, which is the third pillar of the specialty products, the Rallis business was suppressed due to higher import price and lower sales volume, and the sales volume was suppressed due to higher returns from the market for this quarter. However, we are very confident with the new management team in place in Rallis. Rallis should start performing. They have taken steps which some of you would have heard during the Rallis analyst call to put the company back on track in terms of growth agenda. Then going on to our consumer business, the salt continues to remain in leadership position, market share in excess of 25% of overall salt consumption, and salt alone crossed 1 million ton during the year, and it is going to track continued growth. Pulses and spices platform performed well, revenue growth of over 100% over previous year. In effect, spices grew by over 30% and pulses grew, I think, close to 70-odd%. We continue to see strong traction for our products in the market. We will continue to focus on what we call as modern-minded stores and e-commerce, and expand in a very calibrated market manner for the general trade in this business. Tata Sampann, the brand, continues to get bigger and greater brand recognition. And under this umbrella brand, we have launched 2 new health products, and we continue to focus on launching products focused on health and nutrition. There were a couple of products which were launched, especially Tata Sampann Sattu and Tata Sampann Virgin Coconut Oil. And we've also launched snacks now, which is the high protein, low oil snacks, which are under test market and should see expanding into other modern stores very shortly. The other big breakaway for us has been to expand the scope of the consumer business beyond just food into the home care and the fabric care business. The first of the product, Tata DX, Tata detergent product powder, has been test launched in West Bengal and has been very well received in the West Bengal market. We will continue to remain in West Bengal market all through this year, trying to perfect our operational excellence and delivery to market before getting into another state or another region. That is our stated strategy on this business. Finally, on the back of improved performance, the board has declared a dividend of 12 rupees 50 per share, which is subject to approval from shareholders. You would recall last year we had declared rupees 22 per share, which was rupees 11 of normal dividend, a special dividend of rupees 11 in addition to the normal dividend, which was due to the one-time proceeds received from a sale of urea fertilizer unit at Kotrala. To conclude, I would say the growth opportunities in this company are looking exciting. Basic chemistry business continues to witness steady growth on the back of consistent demand across geographies. Metaphor expansion is progressing as per schedule and will help us continue to maintain market leadership across categories in this business. Our specialty portfolio continues to track excellent market movement and is backed up with a specific R&D support from our innovation center. Lastly, our consumer business is shaping up well. The product portfolio continues to remain healthy and exciting. With this, I request John to give some insights on the financial performance.
Thanks, Mukund. I will be brief in this summary, but there are a couple of points I would like to make. On a continuing basis, we've had the highest ever operating profits for the company on a standalone basis and are significantly ahead of last year. Our net consolidated debt is now just below 2,000 crores at 1,909 crores. But after taking off cash of 4,184 crore. On a standalone basis, we have cash in hand of 3,229 crore. Offset against that is debt maturing in the next 6 months relating to ECB and the NCD repayment, after which our cash will just shy of 2,500 crores. As Mukund said, the dividend of 12.5 rupees per share, it represents 41.65% of the profit after tax. On more detail on the financials themselves, consolidated revenue in the quarter was up 8% at 2,759 crore. Our consolidated EBITDA was up 4% at 531, and the consolidated PAT on continuing operations is up 26% at 450 crores. This is really driven by the standalone business, where our revenue is up 15% at 1,059, and our PAT was up 31% at 230 crores. For the year, overall, our revenue of 11,296 represents a 9% increase over 2018. And our PAT, although the overall numbers are down on last year, if you add back 252 crore of tax credit we took last year, our PAT and consolidated is actually up 6.7% on a like-for-like basis. For TCL standalone, revenue up 16% at 4,081 crores. EBITDA is up 9% at just over 1,000 crores. And PAT is up 47% at 918 crores. On that basis, I'd like to open up the floor to questions now.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Viraj Kacharia from Securities Investment. Please go ahead.
Thanks for the opportunity and congratulations for decent set of numbers in such a challenging environment. Hello. Hello.
Hi, please carry on.
Yeah, sure. So my first question is on the business structure. Last call we kind of highlighted that we kind of started with a separate reporting structure for the consumer and for the B2B, the B2B businesses. So just want to get an idea in terms of, if you can provide any update as to where we are with respect to our plans for splitting the company from splitting the consumer and the B2B business.
B2B business. No, what we've done to clarify is that we to give a better color to our results, to have a greater transparency, we've started doing what is called segment reporting of 3 distinct segments which have a different characteristics to them. And those 3 segments we defined as specialty chemistry, basic chemistry, both a chemistry-led product, and consumer product, which is the B2C as you refer to. And in terms of specialty products, the basic underlying, let's say, strategic strength you need to build is research and development and capability to bring on solutions and products to market. In the basic chemistry, the major strategic push you need to do is towards driving cost efficiencies. And in the consumer, it is more about brand equity and distribution strength. So we've started reporting. As of now, within the company, we are clear that we're going to run these three separate business units. Beyond that, we have no structural discussions underway.
Okay. Okay. Second question is, if I look at soda ash or the basic chemistry business, the kind of price increase we have seen, the realization improvement, does that fully cover for the input cost pressure we have seen? And if not, then, do we have any plans to take a further price increase in coming quarters? This is in respect to, the kind of capacity increase we are seeing coming on stream in India. And also in China, we are hearing of almost 3 million tons of capacity which is coming back on stream. The capacity which was shut down. So if you can just provide some color on that.
Sure. As far as India is concerned, you know India is a net import market. So there is actually the net imports into India, we can build 2 1 million ton plants. So really, India will continue to see increased imports and will remain a market which is under, let's say, manufacturing which is below the demand. The local manufacturing is below the demand. That we don't see any shift in that position. So even the new capacity which is coming from some of our new competitors who were, and we must be referring to people like RSPL, that has not upset either the balance in the domestic market nor as the market remains tight. As far as the international business is concerned, there was an extreme amount of tightness in the market last quarter before, which had led to a very high runaway spot prices. The capacities coming on stream in China is going to balance the market a little bit, but it is not going to take the demand-supply equation anything out of balance. In our view, we maintain our stance that markets are going to remain tight, and the producers will be in a position to pass on reasonable price increases, and you will continue to see margin expansion happen. And this will continue up till a point that the prices become attractive enough to put up fresh greenfield facility. In our view, the prices still are not attractive enough for additional new greenfield. These are all mothballed capacities coming on stream, and they will keep coming on stream as the demand increases. So there is still a headroom for prices to trend up over a period of time, and that remains our view going forward.
Okay. Just one more question was on the volume part. If you look at the US operations, we did something like 2.4 million tons of sales back in 2014. But despite the kind of investments we've been making, we're not able to kind of get the volume output we would have hoped for. Similarly, in India, we're kind of in the range of around 7 lakh tons. So how should we see on the volume part, say for FY20? Should we see any positive momentum on the volume, especially considering the fact that the market overall is quite tight?
So to answer your question, yes, I think the unit has capacity, capability to produce more. This year it has certainly underperformed. I think we've already addressed that in the last quarter. We had an external event which they did whatever the best they could do. Even this quarter there was one unnecessary, unintended failure which happened, which sort of disrupted for a couple of days the operations. These events, we must have enough internal capacity not to have these sort of events. So the only thing I would say as far as US is concerned, the plant is fairly capable of producing. We need to apply basically the management team needs to roll up its sleeve and perform better. There's no other term beyond that I would say at this point of time. So it is not in the equipment, it is not in the investments, it is just the operational capability. And I would not fault the management for the last quarter, but certainly this quarter was an incident which could have been avoided. But we are focusing on this and making sure that we help the management to deliver better numbers.
So for India, we are not constrained.
Viraj, I'm sorry to interrupt you. May we request you to come back in here for follow-up questions? Thank you. The next question is from the line of Parthiv Jonsah from NVS Brokerage, and participants are requested to limit their questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. Parthiv, please go ahead. Parthiv Jonsah from NVS Brokerage, please go ahead.
Hello.
Yeah.
Yeah, good evening, sir.
Evening.
So my question is pertaining to the international operations. Can you just throw some detailed light on the UK, Africa, and the US operations? What is the near-term plan for next 3, 5, 7 years kind of thing?
So in terms of UK, if you see, I think we near term, you're saying near term, immediately next year, you may
midterm kind of thing, 3, 5 years kind of. Any internal understanding?
I think the Tata Chemicals Europe would have addressed its pension fund issues. It would be behind it. It would have invested. It would have completed the investment in 2 major projects. One of which it's not putting up capital. Somebody else is putting up capital, and we are just a beneficiary because we are giving them access to set up the unit. So let me explain. The first one where we are putting up capital for which we had taken and the investments have already started. This is the bicarbonate unit using carbon capture out of the flue gas. This will allow the UK unit to convert more and more of its soda ash to bicarb, which is a much higher value-added product, and will allow for margin expansion to happen. In terms of the second one where they're investing, which is energy from waste, this will essentially they're going to get free steam after the project is completed from that energy for waste unit. This will probably reduce their operating costs. It's not going to do anything in terms of the product availability or product range shift or product portfolio. As far as the British salt is concerned, we are investing in fresh equipment there, including new boiler, and all these will add to efficiencies going forward. So in the next 3 years, you would see completely revamped unit. We had committed to you that the sustainable EBITDA out of TCE is about 25 million pounds. And with these investments coming in, it is going to trend beyond that. And we do expect that with these 2 investments coming in, which is funded 3 ways. When I explain 3 ways, part funding has come from government of UK, part funding has come from the company's shareholders, which is Tata Chemicals, and part of the funding has come from pension fund trustees. This is one of those unique cases where pension fund trustees have stepped up and said that they will also forego part of the payouts which are due to them. And lastly, one part of the funding is coming from land sales and winning. All these put together allows us to go ahead and invest to the tune of about 50 million pounds, and the run rate in UK is going to expand by 8 to 10 million pounds. So from 25 million, we expect the run rate in UK to go up to 33 to 35 million pounds. At that point, the UK unit will be fairly sustainable. We'll have a product portfolio which is very much tuned into specialty products and would be a value delivering unit for us. So that's as far as UK is concerned. In Magadi, our focus remains to ensure the current operations run as well, and we consistently hit a $10 million EBITDA number year on year. And once that consistency is done, we will come back to you with specific plan. As of now, there's a major innovation project undergoing there, which is low energy soda ash purification project. As you know, that the standard ash is and pure ash, which is what is sold worldwide. There are quality differences, and we are trying to upgrade the quality. And we had to shut down the pure ash plant because it was guzzling a lot of energy. With the new innovative approach which we have come, we'll be using sun's energy to achieve the same result. But we don't want to commit anything to you on that. We'll keep you updated on where this innovation is going on. And once this innovation has been cleared, it will be low capex but very high value adding approach for improving Magadi further. Magadi does not have any legacy issues. Magadi is a well-run operation. It has the same kind of issues which any commoditized cyclical company would have. As far as US is concerned, I think this continues to be our crown jewel, the biggest cash generating unit which we have. I think our approach has been to fix the operation reliability. It is about how the unit pumps the same quantity of material year on year. But here, as our investments go on the ground in the next 2-3 years and we complete the current phase of investment, we do see approximately 10% increase in the output which is going to come out of that unit, and that is really what you would see as the expansion. But otherwise, what you would see in US is a well-run unit, which is an excellent cash generator for us. So big change in UK, where it is going from a unit which has been a drag on us to being a unit which is going to be one of our finest operating units. There is a possibility of big change in Magadi with the pure ash project, which is based on solar energy, and in US it is going to be debottlenecking, which will deliver the additional volume.
Okay, sir. And what about the consumer business? I believe we have just forayed into the home care segment and or in West Bengal. But what is the route going forward? Are we planning to launch more products pan India, or are we planning to launch these health-based kind of products pan India? And what kind of margins can we look into those?
So let me just say this. I think I said that we have our near-term plan is to deliver 5,000 crores of revenue. And the near-term plan, about half of that expansion, which is broadly, when you look at it, from the current number to the number which we are looking at, current number is about 2,000 crores. About 1,500 crores will be delivered through salt and other current products. And the balance 1,500 crores is going to come from combination of pulses, spices, and new product launches. That is our near-term plan, and we are well on track to delivering it. If you really look at it, year before last and last year, there was a blip in the performance because we are trying to fix some business model and operation issues. After having fixed them, if you can see, really the performance is just accelerated this year. The growth rate has trended up. Salt has grown at consistent volume. The spices has grown at the rate of about 200 to 250% a year. From one year to another year, as well as the pulses has grown in excess of 60%. And we would continue to trend these growth rates year on year. And our near-term target for spices is to go to about 200 crores. Our near-term target for pulses is to go to close to about 750 to 800 crores. That's where we are today.
Okay.
Between pulse and spices, we should get 1,000 crores. With salt and our current portfolio of products which we are selling, which is branded bicarb and stuff like that, they will get another 1,500 crores. That takes you to approximately 2,500 crores. Our current year turnover is about 2,000 crores. That leaves you with a balance of 500, and balance of 500 will come from combination of various products we are launching.
Perfect. Thank you so much. Thank you, and best of luck, sir.
Thank you.
Thank you.
The next question is from the line of Sumant Kumar from Motilal Oswal Securities Limited. Please go ahead.
Yeah, hi, sir. So what was the key reason for lower margin in India basic chemistry segment?
John, you want to take it? Basic chemistry margin drop.
Yeah, the margin drop is more to do with the performance of the cement operation, as well as some higher depreciation as the capex we've deployed in the last couple of years has been capitalized, and some higher fixed costs. But I think the most important point to make here is that we've got ourselves ahead of the energy curve. The question we had previous call was when you're going to recover the energy cost increase that we had from the end of 2018 into early 2019. The price increases we put through in May and September have now washed its way through the system, and we're ahead of that curve now. So operationally, our margins have improved, but we had one or two higher costs this quarter. One was to do with cement, where it was more to do with volume, and higher costs in our raw fixed costs, and some of our trading chemicals against the volume piece that pulled down our overall margin.
Okay. And when can we expect normalization in operating performance of UK business?
UK business, I think, has been so UK business that had one or two one-off this year. That is not going to repeat next year. So I think next year you will certainly see an improved performance in that risk. But as I said, if you ask me when will you be comfortable with UK business delivering, and when you'll be comfortable that it is value adding to the Tata Group of soda ash businesses, it is going to be a journey when we finish the carbon capture project. and that is going to take about 18 to 24 months for us to deliver. So it's all I can say on UK. UK is going to be normal performance next year, the current year, and year after that, once the carbon capture is done, it will trend up by another 8 to 10 million pounds beyond where we are.
Okay. And for US business, despite lower sales volume in US, we have shown a strong margin expansion in Q4. So is there any cost reduction or a higher realization drove the margin, operating margin?
Yeah, as we talked about on the call in January, we did expect to see price expansion in North America, and that's what you're seeing coming through there. There's been an element of a foreign exchange difference. The FX moved from about 64 up to 70 year on year. So it's about 20 crores of that is foreign exchange. But you're quite correct. We have seen big price increases in North America.
Okay. Okay. And so.
I'm sorry to interrupt. May we request you to come back in queue for follow-up questions? Thank you. The next question is from the line of Amar Maurya from MK Global. Please go ahead.
Thanks a lot for the opportunity. Sir, my question is primarily what would be the utilization levels now in the US and in the UK business? And yeah. Hello?
Yeah. Just give us a minute. Just 1 second.
Yeah.
It's close to 88 to 90%. So approximately close to 90%, probably 88 to 90%.
90% in US? Hello?
Yes, it is US. It's US numbers.
Yeah, in US. And how much would be for the UK?
UK, yeah, it's close to 1991. I think
So production is not, we are running flat out. We had some issues on energy, we had some issues on maintenance and manufacturing stability performance, but the plants do run fairly hard throughout the year.
Yeah, so I think just to add to what John has said, we run full utilization. We actually run our plants flat out. It's only if they've got some maintenance issues, you would see the numbers dropping. It's not, so when we run, that's it.
Thank you. The next question is from the line of Meechan from Prithvi Finmart. Please go ahead.
Hello. Hi, sir. I have a few questions. First, regarding the realizations, means how much realizations are we getting towards soda ash in this quarter, and are there any price hikes going forward?
Price hikes going forward. So, as Mukund mentioned earlier, the market still remains tight. Both in the developed markets and in the developing markets. So certainly there are opportunities for price rises. Whether those price rises will actually materialize and when they would, I think is a considered call to be taken. We certainly have beaten the energy price hits that have hit our businesses across geographies. So yes, that the market could bear a price rise, but obviously we need to take those calls and consider that.
And what is the current price of soda ash? I mean, how much realizations for this quarter have you earned?
No, it changes. It varies from region to region. I think there's a blended number out there. Do we share it every region? We will not share this data every region, but I think this, as John said, the way the price change behavior happens is US, the prices are negotiated on a calendar year. So in the Q4, you will see a switch in realization that should tell you about the price realization switch. And as far as India is concerned, it's more dynamic. It could change every 3 months. Kenya again follows the Indian pattern. There's a combination of contract and dynamic pricing. And UK has annual plus multi-year contracts. So they will have a much longer stable prices. So those are the pricing patterns. In terms of specific price itself, I think the international players are operating in that market. And South Asian prices will be about $280, $285.
Okay. And another question is regarding notes that means the investment in Tata Industrial Limited, and like we are converting into a JV. So are we expecting a revenue income from that, and what kind of operations are we going to means in that JV?
It's a joint venture accounting. I don't think we account for revenues. There is a line item on subsidiaries and share of.
Right.
So if you can look at that line, it includes all the JVs and all the associates we have, and it includes Tata Industries, it includes Method and J Oil going forward.
Okay. And one last bookkeeping question. Like our other expenses on a consolidated basis have increased, like it's now 700 crores, and it's almost 25% of our revenue as compared to previous of 21%. So what basically was the reason for that?
I mean, this is a kind of catch-all for a lot of manufacturing expenses, stores, consumptions, packing materials, repairs and maintenance, rent, royalties, taxes, insurances, foreign exchanges, professional fees, other expenses. There's a lot of operational costs within that one block.
They have increased as compared to the previous year by 4%.
But I mean, if you look at the total console number, I think it's up by 286, just under half of that is foreign exchange difference.
Okay. Thank you.
Thank you. The next question is from the line of Rehang Subramanian from Ambit Capital. Please go ahead.
Good evening, sir. Thanks a lot for taking my question. My first question is just a normal one. Could you please tell me what was the EBITDA per ton in the India business for FY19 and FY18?
EBITDA per ton?
Yeah.
Do we share?
Yeah. Only India business, sir.
We don't share per ton product numbers. No.
Achha, you guys don't share?
No.
Okay, sir, no problem. So the next question is, sir, you were speaking a little bit about those investments in UK, right, sir? So I just missed a couple of parts. If you could actually just tell me, like the second investment in which someone else is investing. So who is, which parties are investing, and what is this project exactly? And like, I believe it's an environmental project and it'll save us energy costs. But if you could just elaborate on that, like who is investing and what is the benefit to us, then it would be very helpful.
Yeah, we just need to be clear about this one here. There was a press release or some notes that came out last month that said we're investing $400 million in a sustainable energy facility with basically energy from waste. This is not true. The facility has been built by other parties on our land. That's as far as it goes. We 10 years ago considered investing in that project, but the returns weren't there for us. We did not do that. But we carried on with the planning permission. That's as far as it goes. We will get some benefit from the project because one of their byproducts is steam, and one of our inputs is steam. So we have access to steam from the waste plant. That's as far as it's going to go.
So this is basically burning municipality waste and this usually comes out of London. It is transported by train and then it gets unloaded near our yard, and then we've got land which is permitted already for energy for waste project. And it generates energy for the local community, and then we get free steam out of that. And the quantities and these numbers are being stitched up, but essentially it's going to reduce our operating costs a little bit because part of the steam will then be it will be available to do this energy from waste project.
Okay, sir. And the last thing, the sustainable EBITDA of 25 million pounds for Europe, that is 25 million pounds per year, right? Or quarter?
No, per year.
Okay. Okay. Thanks a lot, sir.
Thank you. The next question is from the line of Madhav Marda from Fidelity. Please go ahead.
Hi, sir. Good evening. Just one quick question from my side. Last quarter, you had spoken about research on the cathode ion, the battery, along those lines. Any update on that project? What's happening?
Sorry, we couldn't hear anything. Could you repeat that?
No, I'm saying last quarter you had spoken about we are entering into a research tie-up for EV battery technology, etc. with a couple of universities. Just wanted to understand any update on that.
So we've tied up with the following agencies in terms of our lithium business. So lithium business, we are building it in three quadrants. Three broad pillars. Firstly, the first pillar is the battery business itself, where our intent is to supply lithium battery to auto majors. The second business is recycling of these batteries, and the third pillar is actives, which is basically the chemical coatings which go into making these batteries. Now, we have, as of now, technology tie-ups and R&D partnership in the lithium battery and the battery recycling business. For battery recycling, our partner is the CMAT, which is a CSIR lab based in Pune. The first lot of trial recycling has been fairly successful, and we're now looking at how do we commercialize it. The second, the first one which I spoke about as far as the battery itself, our two technology partners are SECRI in Karaikudi in Tamil Nadu and ISRO in Bangalore. So I think these are the two entities with whom we have tied up. ISRO is in the process of transferring technology. With Karaikudi, we have ongoing work which is already commenced.
Okay. And how soon do we see us putting up, any investment here, or it is still a couple of years out? Is this going to be research for the next 1 or 2 years?
So in terms of BC, the way it is accelerating, the recycling business may start first, and the battery business itself will be in sync with us getting any commercial order from auto majors. As of now, we are in discussion with a couple of auto majors. It's only when we get commercial orders from them, and that is also dependent on the EV policy of Government of India, which finally has been announced. The car makers are also now ramping up their plans. So we are in discussion with them, and we will update you shortly. And our estimated supply time is somewhere 3 years from now, which is 21-22, if things work out fine. But it is tied to, as far as battery business is concerned, about the auto majors ramping up their production and their plans and sharing it with us.
Okay, just one last quick question.
Madam, I'm sorry to interrupt. May we request you to come back in queue for follow-up questions? Thank you. The next question is from the line of Harish Shamsundar from Franklin Templeton. Please go ahead.
Hi, good evening. I had a couple of questions. First, just continuing along the same vein as the previous question on the lithium-ion project. There was a recent media article about Tata Autocomp being, also looking to get into manufacturing battery packs for electric cars. So how does that fit in with what Tata Chem is looking to do? And second question, sorry, yeah.
So you go ahead and ask your second question before I.
Second one is related to the basic chemistry division in India again, and I just wanted to know what you believe the steady state kind of operating margin on that would be.
So I think I'll answer the first one. In the meantime, John will crawl through to figure out how to answer your second question. The first question, as far as Tata Autocomp is concerned, they have a joint venture with a company called Ocean in China, and that joint venture is for making battery packs. So the way the business works is the battery actives are put together by a battery cell manufacturer, and a large combination of battery cells go out to make battery packs. So the biggest investment and biggest margins in this value pool is in the battery cell manufacturing. Battery pack is relatively lower investment, but also by the very notion, it also ends up being in terms of margins much tighter. So Tata Autocomp is putting up for battery packs, and this is not a business it's a business in synergy with us rather than anything in competing with us, because they would be the buyers of battery cells. So if they ramp up their production, it will be good for us. We will be then ending up supplying battery cells to them. But usually the way it works in automotive industry is the battery pack manufacturer has to buy the cells from those cell are certified by the auto major. So we will still have to get the order from auto major, then route it through Tata Autocomp if he's the preferred location for the auto manufacturer. The one additional feature is battery cell manufacturing is usually centralized in one place, but battery pack units are located much closer to the auto manufacturer's facility itself, because it is about putting all the cells together for different kinds of cars. As the cars come off the assembly line, some cars may be sports version, some cars may be let's say long drive version, and each one will have a different combination of cells to enter. So usually the pack manufacturer then makes the pack as per the requirement of the specific vehicle coming off the assembly line. So as a battery cell manufacturer, we will be supplying to few of the battery pack manufacturers. We may have one or two battery pack manufacturing facility of our own, but that's the second stage. That's one stage after battery cell manufacturing. I hope I've clarified your first question. As to your second question.
Yeah, the EBITDA range for our basic chemistry business is probably in the 25 to 30% range. You have some movements up and down depending on what energy is doing and anything else, but that's the kind of range we work at, between 25 and 30%.
And in this quarter, just clarifying, that's around 24 to 25%.
It's in the range.
I'm sorry?
It's in the range I talked about here.
Right. Oh, the EBITDA. You're saying EBITDA margin of 25 to 30%?
Yeah, that's right, yes.
Okay, right. Yeah, thank you.
Thank you. We will take the last question from the line of Rohit Nagraj from Sunidhi Securities. Please go ahead.
Yeah, thanks for taking my question. My question pertains to any capacity expansions announced by the Trona manufacturing process globally.
No, not really. I think there is no fresh capacity coming in out of Trona process. Most of the capacity that had to come up have come up already in Turkey, and there is no fresh capacity in line. The only new additional capacity coming up is about 500,000 ton of Rohit surfactants in India. Other than that, the Chinese capacity is basically the mothball capacity coming back online. We are not seeing any fresh capacities for which investments are being planned.
Okay, and in terms of adding capacity, if someone were to capex for Trona process, how much time will it take for them to put up the capacity in terms of maybe a couple of years, 3 years?
It's very difficult to generalize what kind of existing surplus exists in which section of the plant. But usually, if you say you have to put up a complete greenfield end to end, I think this is anywhere between 30 to 36 months. And then you need to add the time needed for environment clearances, which can be very unpredictable in some of the things.
And for these newer capacities, are the costs a little higher than what they are for the existing ones?
So I did make a statement, and I will just stick to the statement which I made, that current prices in the market do not lend themselves to fresh capacities being able to return adequate return over weighted average cost of capital.
So, thank you. Thanks a lot for all the answers. Best of luck.
Thank you.
Thank you. I now hand the conference over to the management for their closing comments.
Thank you, everyone. I just want to conclude by saying that we are well on our track on building 3 robust businesses, continuing to run the basic chemistry business for cash and bringing capacities up only through debottlenecking. In terms of consumer business, we are continuing to push the agenda in terms of building revenue and profit through the 3 existing products which we have the longest experience with. So when I mentioned 5,000 crores, 4,500 odd crores should come from salt, pulses, and spices. The balance 500 will be new categories. But as we go every year, we'll sort of guide you with additional numbers which we are planning. We are well on track in terms of delivering those even in the next year budget. In terms of our specialty business, as I said, we have 4 pillars. The first pillar is agro sciences, which is Rallis, which we've got a new management team in place, and it's got 800 crores of exciting investment underway, which we are very much on track to delivering. The second business is the nutrition solution business, where the plant in Nellore is up for commissioning end of this month and should be able to start commercial production by end of the year, by which we expect to get all regulatory approvals. The third business is our third pillar is advanced material business, where allied silica, which we had acquired in Cuddalore, is now ramping up for commercial production, and quality approvals have been since gotten for both food and the rubber grade material. And the last one is energy business, which I did speak a bit about. This is the one which is in nascent phase, but we are very excited. The future of auto industry is electric all the way, and we will be there to support them through three broad approaches. One is battery recycling, battery actives, and battery cells. So we look forward to this journey and your support going forward. Thank you.